10-year, as I look at it right now, 92 basis points. What's your reaction to what we've seen in the bond market?
Well, the bond market is rallying because the Fed has reacted to the seizure in the corporate bond market, which is not getting enough attention. I mean, the junk bond market widened out about the same as it did in the fourth quarter of 2018, and it's widening out massively again today. And Jay Powell has a background not as a theoretical economist, but as a private equity person. And his actions on short rates have been pretty much in reaction, ever since he started the easing cycle, pretty much in reaction to problems in the corporate bond market, which are really worth paying attention to, because obviously the stock market has benefited a lot from buybacks. And as the corporate bond market is weakening, now that it's over a $10 trillion milestone, amazingly, $10 trillion of corporate bonds, as corporate bond yields are going up just as rapidly as Treasury rates are falling, it's kind of problematic for that buyback aspect of the market. So the Fed has cut rates to 50 basis point, intra-meeting panic emergency cut in reaction to even the investment grade bond market being shut down for 7 business days. And so if we look at history, once the Fed does a panic intermeeting rate cut, particularly when it's 50 basis points, which is usually what it is when they have to panic, they typically cut pretty quickly again, even at the very next meeting. So I'm in the camp that the Fed is going to cut rates again, perhaps even in 2 weeks, and that we will see short rates headed towards zero. I agree with Jim Bianco, who's been talking about that. I'm not sure I agree with him that they're going to cut to zero immediately, but I think we have another rate cut coming. In the meantime, Treasury bonds are not really a place to make money anymore. They're a place to not lose money. And that's what's happening. I mean, at 90 basis points-ish on the 10-year, even if they go to zero, you're not even looking at a 10% rate of return over a 1-year time period.